I'm Max, mathematician, and welcome to the Speculaverse, where we speculate. And none of this is financial advice or pure geopolitical, stock market, minerals, speculation. So cool, let's jump into it. Today, I want to look at gold relative to the S&P 500, or the other way around actually, and uranium. What's happened in the past to gold, with respect to some historic events. Okay, so the graph that we're looking at right here to start with is the price of S&P 500, like one share in it, which would mean like one equally weighted portion of all of the S&P 500 shares. How much would it cost you to buy one of those? Divided by an ounce of gold. So today, that gives us this ratio. And today, that ratio is 1.3. So 1.3 S&P 500 shares, SPX USD, SPX price, about 7,000 divided by 5,000 for gold. Gold is on a tear. Gives us this ratio of 1.3 today. So in the past, what did this ratio look like, and what are some important levels that this broke? What seems to be an important level is 1.5. For whatever reason, it's a very round number, so maybe we could move it around a little bit. But in the past, breaking through this level, 1.5, that ratio, was in 1973 and in 2008. And, I wasn't alive in 1973, but in 2008, I remember as being a big crash. 1973 was also a crash, but for a completely different reason. Not this kind of mortgage crisis. It was actually some sanctions imposed on the US during the Yom Kippur War. That the US was. And remember, we're looking at everything here in S&P 500 divided by gold terms. So this is American stock market. So in October 1973, the US got sanctioned by OPEC. A lot of Arab countries were unhappy with the support, US support during the Yom Kippur War. But leading up to that, you could see it had already broken through this level, and it was at 1.14 when those sanctions actually got imposed. It almost looked like it was going to recover as well on the way up to those sanctions being imposed in October 1973. Look at the bottom there. Okay, March 1974 is an important date because these sanctions got lifted, but I believe that the American stocks continued, over there. The sanctions got lifted. Kissinger negotiated some kind of deal with OPEC. I don't know how. Master negotiator guy. It looked like S&P 500 would be safe to invest in again instead of gold, but that was proven wrong, and it took some time to recover. So from April to December, more than half a year. But then S&P 500 had a great rally, but then continued to bleed down. This is probably something else, The point is, not related to this OPEC thing, but the point is that once it broke this 1.5 level, it did just continue going down, the S&P 500 relative to gold. Okay, so let's have a look at today. Before we do that, let's have a look at 2008 and some important dates there. Here, S&P 500 broke this level leading into the mortgage crisis. The NDX, which is, not the S&P 500, a more tech-related index of American shares, hit an all-time high in October 2007, which is October, over there. And it continued to, not continued, there it started to really bleed. It was on its way down relative to gold, but there it started to really bleed. And in USD terms, that's when it was at its highest, October of 2007. In 2008, we were full swing, and I think the crisis was announced in 2008, June 2008, so around here. That's when the bear market was officially announced. By then it's too late. It means that the market has gone down for 2 quarters already for it to be classified as a bear market. So yeah, continued to bleed till there, which is, I believe, March of 2009, the index bottoms. So in dollar terms, it bottomed. But in gold terms, it bottomed too in March of 09. March of 09, yeah, which is kind of interesting. Okay, so where are we right now? Right now we are, I'd say, fully through that 1.5 level. We're at 1.3 at the moment. Historically, that was a kind of like a little tipping point as well. If you look at these two, that wasn't a tipping point. That was already long gone. But in the mortgage crisis, that was a tipping point. And there might be some historic parallels, especially with this OPEC deal. So let's have a look at current day news. The US invaded Venezuela in January. We're currently in January. This is very fresh news. And this kind of like secures their oil supply in a way that could prevent what happened in 1973. I'm not sure if that was the idea behind it. It's impossible to know what they're up to. And another thing that's happening in April is that Trump will still skin. He's going to visit China and he's got to negotiate. So it's a good idea to get as much of the oil that would be bound for China locked down and under US control before that negotiation. But also just like during the OPEC embargo, the trade restrictions on oil going to the US in 1973 from OPEC nations. We might see the same thing if the US decides to invade Iran now. And it might not necessarily be that oil gets cut off this time to the US. They've secured their oil reserves from Venezuela. So potentially that was one of the main countries that relies on oil from Iran is China and that region in general, which a war with Iran would make that very insecure. That pipeline oil, that oil going to China. So potentially we're in a different situation now, but I would argue that because of how overvalued stocks like the Magnificent Seven are, we're kind of in a similar situation, but they've prepared for an oil embargo, but not for the AI bubble popping, which feels inevitable. The AI companies are not profitable unless one of them, discovers the super intelligence or whatever. But from an investor's perspective, every dollar that they get in, they've got to spend $3 to generate. So it doesn't work as a company running these AI LLMs. And I think 25 to 30% of the world's market cap is just in the Magnificent Seven, which feels like too much. and we can see maybe there is already some discomfort, and that's why the S&P 500 is currently losing value quite a lot in gold terms. But yeah, that's what I wanted to talk about in terms of gold and the S&P 500. If we quickly turn to uranium. I'm inclined to think that uranium is, I was initially inclined to think that uranium was a good bet against the US stocks, but I'm gonna show you what changed my mind. So over here in the candles is uranium. It's an ETF of uranium mining companies and processing companies. Biggest one included in here is CCJ. If you want to look at that, that's a phenomenal company, but it's already priced a little bit too high. Who knows if that's true or not? It can go up or down, who knows? But if the goal is risk from American stocks, so what we're looking at here right now is just the uranium ETF in US dollar terms, and then in blue, the NDX, the NASDAQ. At some point in recent history, it looks like about 2007, sometime between here, 2016, 2019, uranium and the NASDAQ got super highly correlated for some reason. So if you think that tech stocks are in a bubble, then uranium is definitely not a safe haven from that. And maybe that's because there's some contract and some reliance on these tech companies to sell uranium to them so they can run these nuclear reactors to power these kind of like gigantic AI data centers cleanly, in a sense. Uranium is pretty clean. But yeah, you can see that this correlation, which was pretty much inverse over there, uranium was going down, NASDAQ was going up, and even here, a little bit inverse. There, they share a bottom, a little bit inverse, they share a top. There's no correlation, that just has its own top. But as you start going further to the right, you can see that dip correlates, that dip correlates perfectly. It starts going up. They share the same top. They share the same trough. And they continue. There's some more obvious correlation. So I'd say right now, it doesn't look like uranium is a safe haven from American tech stocks. So that is a fully correlated bet. Yeah, but I have a small uranium position. I'm gonna close that. I have a gold position at the moment, which I will keep open. I'm fully out of American tech stocks. They could go up more, who knows? It's impossible to time the top. But I feel like historically, shout out to Ben Cohen for this ratio, historically, this level being broken has just led to bad things for the US stocks. Yeah, that's it. That's it on gold, uranium, S&P 500, NASDAQ. Another interesting thing to talk about, which I'll talk about in the next video, is the similarity between the Fed being taken over in the US and the inflation that the world expects from that, and the similarity and what happened in Turkey, to the Turkish stock market, to the Turkish lira, when Erdogan, however you say it, ousted the Federal Reserve chair in Turkey. I think we see the same thing happening in the US. One difference is that obviously the US has locked down oil supply from Venezuela right now, so their energy prices won't rocket even if they start printing US dollars. But yeah, it feels like an interesting parallel. But yeah, we'll go over that in the next episode. So cool. Like and subscribe if you are a speculator too. And remember, this is all speculating. No financial advice. Thanks for watching. Ciao.